Welcome, I'm Rocky Horner, and thank you for joining me for our Interbank FX series on a number of topics we've been covering throughout the month. Today's topics we'll cover in just a moment, but before I begin, let me give you all the Forex disclaimer. Please listen up, this is important. Trading in the off-exchange retail foreign currency market is one of the riskiest forms of investment available in the financial markets and suitable for sophisticated individuals and institutions. The possibility exists that you could sustain substantial loss of funds, and therefore you should never invest money that you cannot afford to lose. Nothing in this presentation is a recommendation to buy or sell currencies, and Rocky Horner, myself, is not liable for any loss or damage, including without limitation any loss of profit, which may arise directly or indirectly from the use of my tools, Rocky Horner's tools, or the reliance of such information. Okay, so we're here to talk about Forex. And specifically, today's topics are understanding price action, drawing trend lines, using PRS, which is the pattern recognition software that's available over at interbankfx.com, Fibonacci levels, and market cycles. Now, I'm probably going to go ahead and cover price action first, then we'll get into some drawing of trend lines and chart patterns. We'll cover market cycles as well, and Fibonacci. Now, Fibonacci will be very last. I'm going to touch on it briefly and basically show you how I set it up on the IBFX4 platform. So we're not going to get into a full session of Fibonacci. I would love to have time to do that, and in fact, we do, because at the end of this month, we're going to have a huge blowout cumulative session, which I call Super Saturday, which allows us to spend 4 hours together. There will be breaks, don't worry, but we're going to spend 4 hours together and just get neck deep in this stuff. We're going to take all the lessons that we've discussed throughout this month, throughout this series of Forex presentations. We're going to put them all together, and really you'll see it all gel then, because this is really a process of just getting a little bit of information every single week until you've got the makings of enough knowledge to begin to put them together in a methodology using the strategies that I'm teaching. Okay, so I'm going to actually go ahead and start, and I'm looking at my notes right now. I'm going to go ahead and start with market cycle analysis. And market cycle analysis, I'm going to give you some history on this because I think it's relevant. I don't like turning into the history teacher, although that was one of my favorite subjects in school. I do believe that understanding the background of market cycles is important because it gives you an idea of just how time-tested this is. Market cycles, or market trends as they were known, were written up and discussed, taught, I guess you could say, by Charles Dow. And yes, that Charles Dow of Dow Jones, Charles Dow, who we now look at his collective writings and called Dow theory, and he discussed this idea of market trends. Now, he discussed 3 trends: accumulation, markup, and distribution. In all due respect to Charles Dow, I actually add in markdown, and a lot of traders do, because Charles Dow most obviously wrote about the stock market, which has a bullish bias. People are typically going to be looking long. Here we're nimble in the Forex market. We can look long, we can look short. There's always something with a bull market in Forex. You know, if the U.S. dollar is weak, the euro is strong. There's always something moving up against something else or moving down against something else. So we don't have to have that bullish bias. The idea of the 4 market cycles, again, completely from Charles Dow, probably the biggest influence in my trading next to Richard Schabacker. But this idea of market cycles has been the distinction that has made everything else click in my trading life. So if I haven't really stressed how important this is, please hear me out. This is very important. Market cycles, there's 4 of them. If you want to go ahead and write this down, please do. It starts with accumulation. Now, this doesn't mean that every market starts with one cycle or the other, or that they cycle through in a particular order. They do not. Okay, they can happen in any succession. They can start anywhere. I just want you to know them individually. So accumulation is that cycle which is a sideways, quiet, cycle, and I'm going to go ahead and see if I can find a chart in accumulation while I'm discussing it. It's a sideways market cycle that typically has a fairly defined support and resistance level, and this works. Okay, here we go. Here's an accumulation, pretty decent little accumulation right here. Accumulation is really distinguished by the idea of having a fairly solid support and resistance level. Okay, and what that means is that the variance between the highs or the lows is usually 5 pips or less. The less variance there is between those high prices and the less variance there is between those low prices, okay, the more solid I call that level. Obviously, we like solid support and resistance, solid floors and ceilings. The more solid it is, okay, the more reliable it is, right? So accumulation is a narrow, sideways